Welcome to this explainer. Okay, so you've decided to pack up your laptop, grab your passport, and live that digital nomad dream. If you're a focused learner trying to untangle the absolute web of working abroad as an American, you are definitely in the right place. Because here is a reality that completely shocks almost every U.S. citizen who moves overseas. Leaving the country, well, it doesn't mean leaving the IRS behind. Today, we're going to systematically break down exactly what you legally owe, what you can shield, and the hidden traps that catch people literally years after they thought they'd escaped the system.
To make this crystal clear, here's our roadmap for today. First, the citizenship tax trap. Second, the FIEE relief valve. Third, the self-employment surprise. Fourth, beware of sticky states. Fifth, FBAR and hidden penalties. And finally, number 6, putting it all together.
All right, let's jump right into part 1, the citizenship tax trap, and why your passport is the trigger.
So picture this. The confusion usually hits right around year 2 of a nomad's journey. A friend casually asks, "Hey, did you file this year?" And absolute panic sets in. Why? Well, look at how isolated the U.S. is here. The United States is one of only 2 countries in the entire world, the other one being Eritrea, that taxes based on citizenship rather than residency. Think about that. If you're British and you leave the UK for good, eventually you stop owing UK tax. The rest of the world uses residency-based taxation. But for us Americans, your passport is the trigger, not your address. You could literally live on a remote beach in Thailand for 30 years, and you are still technically required to file a US tax return every single year, reporting your worldwide income, until you move back or formally renounce your citizenship. The huge takeaway here is simple. Your filing obligations, they do not stop just because you boarded an international flight. Moving on to part 2. The FIE relief valve in shielding your income. Okay, take a breath, because it's not all doom and gloom. The IRS actually built a massive relief valve into the tax code specifically for Americans working abroad. For the 2025 tax year, the Foreign Earned Income Exclusion, we just call it the FIEE, allows you to legally exclude roughly the first $130,000 of your foreign earned income from U.S. federal income tax. Let that sink in for a second. If you're a remote software developer making 90 grand a year living on a beach in Portugal, and you qualify for the FIEE, you could legally owe exactly $0 in U.S. federal income tax on that money. And this is a huge but. How you actually qualify is absolutely crucial, because it's not automatic. You have to pass one of 2 very strict tests. The first is the physical presence test. This means you have to be physically outside the U.S. for at least 330 full days during any rolling 12-month period. And yes, it requires meticulous documentation. Flight records, passport stamps, hotel receipts, the whole shebang. The alternative is the bona fide residence test. This one's a lot harder to prove. It's really meant for expats who have set down deep, permanent roots in one specific foreign country with a local lease and real ties. It's not for true nomads bouncing from Airbnb to Airbnb. And here is why this matters so much. If you miss that 330-day requirement by even one single day, you don't get a partial exclusion. You lose the entire thing. That one day could literally cost you tens of thousands of dollars. This is exactly why smart nomads live and die by their travel spreadsheets.
All right, part 3, the self-employment surprise, the 15.3% trap.
This is where freelance nomads who think they're totally safe suddenly get ambushed by unexpected IRS bills. Notice the big distinction here. The FEIE only shields you from federal income tax. It does absolutely nothing, zero, to excuse you from self-employment tax. So if you're a freelancer or a sole proprietor, you still owe roughly 15.3% on your net earnings to cover Social Security and Medicare. FEIE or not, that bill is coming. This catches people off guard constantly, you know? They hear, "I don't owe federal tax," and just assume that translates to owing nothing at all. Then spring rolls around and bam, they get slammed with a bill for thousands of dollars. Now sure, there are advanced corporate structures to help mitigate this, but the core lesson for today, never, ever confuse federal income tax with self-employment tax.
Part 4 now, beware of sticky states and escaping your hometown.
Look, just because you left the country entirely does not mean your home state has forgotten about you. We call these sticky states. Places like California, Virginia, New Mexico, and South Carolina are notoriously aggressive. If you move abroad but keep a driver's license, a bank account, or even just significant family ties back in those states, they can legally argue that you never actually stopped being a resident. And guess what? They're going to demand a cut of your worldwide income. Compare that to nomad-friendly states like Texas, Florida, and Washington, which have no state income tax at all. The absolute master strategy here is establishing residency in one of these no-tax states, completely cutting ties with your sticky state, and changing all your IDs and registrations before you get on the plane. You've got to do it before you leave, not after you're already drinking a coconut in Bali.
Let's look at Part 5, FBAR and Hidden Penalties, or the Treasury's Watchful Eye. Okay, we're escalating things now. We are moving from the IRS to the U.S. Treasury. $10,000. That is a surprisingly low trigger for the FBAR, the Foreign Bank Account Report. We're talking about reporting requirements that have absolutely nothing to do with how much tax you owe, but everything to do with massive, life-altering penalties. Look, if you're a digital nomad, you're almost certainly going to use foreign bank accounts or international financial apps. If the combined total across all of your foreign accounts exceeds $10,000 at any point during the year, even for literally 5 minutes, you are legally required to file.
And the realities of this requirement? They are severe. The FBAR is completely separate from your regular tax return. If you willfully fail to file it, the penalties can technically reach up to $100,000 or 50% of your account balance, and that's per violation per year. And don't even think you can just hide the money. Because of a law called FATCA, foreign banks are essentially strong-armed into reporting their American account holders directly to the IRS. Honestly, the compliance burden is so incredibly heavy that a lot of foreign banks just flat out refuse to open accounts for U.S. citizens anymore. The reality is, having offshore money is practically never invisible to the U.S. government.
Finally, Part 6, putting it all together with a real nomad example.
To cement all these abstract rules we've been talking about, let's actually look at how this math works in practice. Meet our hypothetical digital nomad. They're a U.S. citizen working as a freelance marketer. They pulled in a net income of $95,000 last year. They were super careful with their calendar, spending exactly 340 days outside the U.S., working from 3 different countries. And crucially, they established residency in Florida right before they left.
So, here's the final receipt for their tax year. Because they cleared 330 days out of the country, they easily passed the physical presence test. That means their $95,000 is fully shielded by the FEIE. So they owe exactly $0 in federal income tax. Because they're a Florida resident, $0 in state tax. But since they are a freelancer, that 15.3% self-employment tax still hits them. That results in a bill of roughly $13,000 to $14,000. And, of course, if their foreign accounts cross that $10,000 mark at any time, they've got mandatory FBAR paperwork to file. The ultimate takeaway from all this: being a nomad results in a meaningfully lower tax bill than staying in the U.S., for sure, but it is definitely not a zero tax, zero paperwork, free-for-all. But here's a final thought I want to leave you with. Everything we've discussed today assumes you're moving to places where you pay little to no local tax. But what if you move to a high-tax country like Germany or Spain? What happens if using the famous FEIE actually becomes a massive financial mistake and you should be using the foreign tax credit instead? And what are the most common filing errors that cause the IRS to send audit notices years down the line? That is a whole different layer of the tax code, and it's exactly what you need to discover next to truly master your global finances. So what's your next move?
Okay, picture this. What if the biggest threat to your freelance income isn't actually finding clients, but the passport sitting right there in your pocket? Welcome to this explainer, where our main goal today is to completely demystify the incredibly complex and, honestly, kind of intimidating web of U.S. citizenship-based taxation. We really want to equip you with the knowledge to legally minimize your tax bill, all while dodging those severe hidden penalties that catch so many expats and digital nomads totally off guard. So if you're working remotely from across the globe right now, or even just dreaming about it, you are in exactly the right place.
Look, here's a fact that surprises almost every single American when they first move abroad. The United States is one of only 2 countries on Earth that taxes its people based on citizenship rather than residency. And the only other country that does this? Eritrea. I mean, wow, that is just a truly staggering statistic when you let it sink in. And honestly, this brilliantly illustrates why so many expats feel this constant nagging sense of anxiety. Moving to a gorgeous villa in Bali or a trendy little apartment in Lisbon doesn't suddenly erase your IRS obligations. It turns out the IRS loves the beach just as much as you do. For most of the world, if you leave a country for good, you eventually stop owing them taxes. But for Americans, your passport is the trigger, not your address. You could literally live outside the U.S. for 30 years, and you would still technically be required to file a return every single year. The paperwork doesn't just stop because you boarded a plane. All right, so here is our roadmap for today's explainer. We'll start with the citizenship tax reality. Second, we'll weigh FEIE against the foreign tax credit. Third, we'll uncover hidden state and self-employment taxes. Fourth, we'll dive into banking, healthcare, and retirement. And finally, we'll wrap up with 5 costly nomad mistakes you absolutely need to avoid. Let's dive right into Section 1, the citizenship tax reality, and the global rules you need to play by. Now, while the IRS rules are notoriously strict, they have actually built in a massive relief valve for Americans living overseas. For the 2025 tax year, the Foreign Earned Income Exclusion, we'll just call it the FEIE, legally lets you exclude roughly the first $130,000 of foreign earned income from U.S. federal income tax. To put that in perspective, if you're a remote software developer making 90 grand a year living in Portugal and you qualify, you could legally owe exactly $0 in U.S. federal income tax on that money. It is an absolutely game-changing tool. But here's the catch. Qualifying is not automatic. You have to pass one of 2 very strict tests. The first is the physical presence test. This requires you to be physically outside the U.S. for at least 330 full days in any 12-month window. The alternative is the bona fide residence test, where you have to prove you've built a genuine established life and local ties in a foreign country, like having a long-term apartment lease. But a huge warning here. If you're relying on the physical presence test and you miss that 330-day mark by even a single day, yep, you lose the entire exclusion for that year. Not a fraction of it, the whole shebang. Moving on to Section 2, FIE versus the foreign tax credit. This is all about choosing your strategy. This is absolutely crucial because picking the right system dictates how much of your own money actually stays in your pocket. As we said, the FEIE excludes your income entirely from federal tax. So this is almost always your best bet for low tax or no tax spots like Dubai or Panama. On the flip side, the foreign tax credit, or FTC, works totally differently. It gives you a dollar-for-dollar credit against your U.S. tax bill for the income tax you've already paid to a foreign government. This is incredibly useful if you live in a high-tax country like Germany or France, where you might be paying, say, 35% locally. The FTC can totally wipe out your U.S. bill and even lets you carry forward unused credits to future years. Just keep in mind, if you use the FEIE and then revoke it to switch to the FTC, the IRS actually locks you out of using the FEIE again for 5 whole years unless you beg for special permission. All right, Section 3, hidden state and self-employment taxes, aka the surprise bills. Okay, so this is where the financial traps really snapshot on freelance nomads, usually right after they confidently assume they owe 0 taxes. Listen closely. If you are a freelancer or a sole proprietor, the FEIE only excludes you from federal income tax. It absolutely 100% does not excuse you from the 15.3% self-employment tax. That's the tax that covers your contributions to Social Security and Medicare. People hear no federal tax and think they are entirely off the hook, only to get slapped with a massive self-employment tax bill the following spring. It happens all the time. And hey, the surprises don't stop at the federal level either. Your home state might still be waiting with its hand out. Certain sticky states, we're looking at California, Virginia, New Mexico, and South Carolina, are notorious for aggressively taxing your worldwide income unless you completely sever ties. Contrast this with no-tax states like Texas, Florida, or Washington. Experienced nomads know the real strategy here is to establish residency and get a new driver's license in a no-tax state before getting on the plane to move abroad, definitely not after. Now, we have to talk about the FBAR. This actually has nothing to do with owing taxes, but it has everything to do with massive, life-ruining penalties. If the combined total across all your foreign bank accounts exceeds $10,000 at literally any point during the year, even for just one afternoon, you must file a foreign bank account report with the Treasury Department. And willfully ignoring this, that can hit you with penalties of $100,000 or 50% of the account balance per violation, whichever is greater. And if you're thinking, well, how would the IRS ever find out about my little account in Spain? Let me introduce you to FATCA. The Foreign Account Tax Compliance Act literally forces foreign banks to report their American account holders directly back to the IRS. This massive compliance burden is exactly why so many foreign banks will flat out refuse to even open an account for a U.S. citizen. Your overseas money is definitely, for sure, not invisible to the U.S. government. Let's ground all these abstract rules into a real-world scenario so you can see how this actually plays out. Imagine a freelancer making $95,000 a year, they're outside the US for 340 days, and they smartly became a Florida resident before leaving. The result? Zero federal tax, thanks to the FEIE. Zero state tax, thanks to Florida. But they still owe roughly $13,000 to $14,000 in self-employment tax, and they absolutely must file that FBAR. So yes, it's a meaningfully lower tax bill, but it is far from a no paperwork situation. Which brings us to Section 4, banking, healthcare, and retirement. Let's talk about the everyday logistics of nomadic life. Leaving the IRS aside for just a minute, let's talk about the very real logistical challenges of living out of a suitcase. First up, healthcare. Your U.S. health insurance largely doesn't work abroad, and the Affordable Care Act marketplace requires a U.S. address. So you basically have three main options. You've got travel medical insurance, which is cheap but really just for emergencies. You've got dedicated Nomad health insurance for ongoing care as you hop between countries. Or you just pay out of pocket locally, which is honestly incredibly cheap in a lot of places. Whatever route you choose, you absolutely must build a healthcare line item into your budget. Just one unexpected hospital visit without coverage can instantly wipe out years of those hard-earned tax savings. Then there's retirement, and this is a really tricky trap. If you fully exclude all your income using the FEI, you technically have zero taxable compensation in the eyes of the IRS, which completely blocks you from contributing to an IRA. This right here is why some nomads actually prefer the foreign tax credit, because it leaves your income eligible for those IRA contributions. Also, keep an eye out for totalization agreements. The US has these with about 30 different countries to ensure you aren't double paying Social Security taxes to both nations at the exact same time. And your banking setup? Yeah, that needs a total overhaul too. US brokerages and banks are increasingly freezing or just straight up closing accounts the second they detect a foreign address. To survive this, experienced nomads use a very specific banking stack. A US bank for stability, usually registered to a trusted family member's address back home, an international friendly account like Wise or Charles Schwab for handling multiple currencies and getting ATM fees refunded, and then often a local foreign account in the country where they're currently residing. All right, let's bring it home with Section 5, 5 costly nomad mistakes. You'll want to avoid these traps at all costs. Let's make this highly actionable and focus on the exact errors that trigger brutal IRS audits, sometimes years after the fact. Mistake number 1, not filing at all. Remember, the FIE isn't automatic. You have to actively claim it on a return. Mistake 2, miscounting days. And here is a huge tip. A layover or connecting flight through the US legally counts as a day in the US and can completely ruin your physical presence test. Mistake 3, missing the FBAR. It has its own separate deadline and goes to the Treasury Department, not the IRS. Mistake 4, ghosting a sticky home state, which will happily chase you down for back taxes and interest. And mistake 5, assuming a foreign LLC somehow erases your US tax obligation. It doesn't. Actually, scratch that. It doesn't just not erase it. It creates a mountain of additional, highly complex reporting requirements. Ultimately, being a digital nomad absolutely lowers your tax bill legally, but it requires some very deliberate planning. As this quote perfectly summarizes, you're trading one set of complexity for another set. You leave behind a simple, straightforward W-2, but you take on day counting, state residency cleanup, and international banking. The most successful nomads are simply the ones who understand these global reporting rules and plan their lives deliberately around them. So, the ultimate question for you is this: is your passport your greatest asset or your biggest financial liability? The answer depends entirely on your preparation. Don't let invisible borders drain your hard-earned wealth. If this explainer helped you see the matrix of global taxes just a little bit more clearly, please make sure to subscribe to this series for more deep dives into expat finance. Until next time, safe travels and smart planning.